Imagine two people walk into the exact same bank on the exact same day, asking for the exact same thing, a loan. One of them gets a smile, a handshake, and an offer to come back next week to discuss some other opportunities. The other gets a form, a fee, and a polite but firm "we'll get back to you." Same bank, same building, same employees. So why did they get treated so differently? Here's the uncomfortable truth most people never think about. Your bank doesn't see you as a person. It sees you as a number. And depending on which number you are, the entire experience, the fees you pay, the deals you get, the attention you receive, quietly shifts underneath you without you ever noticing it's happening. Today we're going to pull back the curtain on something almost nobody talks about. How banks actually treat people differently at every level of wealth, why that happens, and what it secretly teaches us about how money really works. Most of us grow up believing banks are neutral. A bank is just a place that holds your money safely, right? It doesn't have opinions about you. It doesn't play favorites. A dollar is a dollar, whether it belongs to a college student or a millionaire. That belief feels comforting. It also happens to be completely wrong. Here's the thing, a bank isn't a charity, and it isn't a public service. It's a business. And like every business, it makes more money from some customers than others. The moment you understand that one sentence, the entire relationship between you and your bank starts to look different. Think about it like a restaurant. A regular fast food customer and a guest with a reservation at a 5-star steakhouse are both customers. But nobody expects them to get the same experience, the same attention, or the same menu. The restaurant isn't being unfair. It's simply built around different types of guests who generate different types of value. Banks work exactly the same way. Except instead of menus, they have something far more powerful: tiers. And almost nobody tells you which tier you're sitting in. Let's break this down level by level, because once you see the pattern, you'll never look at your bank statement the same way again. Level 1, the overdraft zone. This is where most people start their relationship with banking, usually as teenagers or in their early 20s. You open a checking account with a small balance, maybe a few $100s. At this level, the bank doesn't make much money from you directly. Your balance is too small to lend out in any meaningful way. So how does the bank make money from you instead? Fees, overdraft fees, minimum balance fees, ATM fees if you use the wrong machine, late payment fees on a starter credit card. Individually, these fees look small, $5 here, $35 there. But multiply that across millions of customers, and suddenly fees become one of the most profitable products a bank offers. Here's the psychological trick hiding underneath this. When you're charged a $35 overdraft fee for being $2 short, it doesn't feel like punishment for poor planning. It feels like the system is designed to catch you off guard. And in a very real sense, it is. Banks know that people under financial stress are more likely to make small timing mistakes. Forgetting a bill date, miscalculating a balance. The fee isn't really punishing carelessness. It's monetizing financial stress. Level 2. The comfortable middle. As your balance grows, let's say a few thousand to a few tens of thousands of dollars, something interesting happens. The fees start to soften. Maybe you qualify for a checking account with no monthly fee, as long as you keep a certain balance. Maybe customer service starts to feel a little more patient. At this stage, the bank starts making money from you in a different way. Through lending. Your money sitting in your account isn't just sitting there. Banks lend out a portion of it to other customers as mortgages, auto loans, and business loans, charging interest in the process. The more stable your balance, the more valuable you become as a source of lendable cash. This is also the stage where banks start offering you credit cards with rewards, because now you're seen as a low-risk, semi-profitable customer. Notice the subtle shift. You're no longer just a fee target. You're now a small but steady source of fuel for their lending engine. Level 3. The private banking door. Now picture a customer with a few $100,000 in savings and investments. This is where the experience changes dramatically. Suddenly, there's a dedicated advisor. Suddenly, fees that used to apply quietly disappear when you simply ask. Suddenly, the bank is calling you, not the other way around. Why? Because at this level, you're no longer just a depositor, you're a potential long-term partner. The bank wants you to bring your investments, your mortgage, your business accounts all under one roof, because the more financial products you hold with them, the more layers of profit they earn from you: management fees, advisory fees, interest spreads, and more. This is the level where banks start treating customers less like account numbers and more like relationships worth protecting. Level 4. The invisible tier. At the very top, multi-million-dollar net worths. Banking barely resembles what most people experience. There are no public fee schedules, no standard checking accounts. Instead, there are private bankers, customized loan structures, and access to investment opportunities that never appear on any public website. At this level, the bank isn't trying to extract small fees anymore. It's competing for a relationship that could be worth millions in fees over decades. So the treatment flips entirely. Instead of the bank protecting itself from the customer, the bank works hard to make the customer feel protected, valued, and exclusive. Now here's where this gets genuinely interesting, because the real lesson isn't really about banks at all. It's about a psychological pattern that shows up across almost every part of the financial world. The amount of friction you experience with money is directly tied to how much of a buffer you have. When your balance is thin, every fee feels personal, every mistake feels costly, and the system seems to work against you. When your balance is thick, the same system suddenly feels generous, flexible, and forgiving. This creates something we could call the buffer effect. It's not that wealthy people are smarter about avoiding fees. It's that having more financial cushion changes how the entire system interacts with you. Banks aren't reacting to your intelligence. They're reacting to your risk profile and your profit potential. This explains a strange paradox many people notice but rarely articulate. The less money you have, the more expensive it seems to be poor. Not because prices are different, but because the margin for error disappears. A $5 fee on a $5,000 balance is almost invisible. The same $5 fee on a $50 balance can trigger a chain reaction. A missed payment, a late fee, a damaged credit score, higher loan interest rates down the line. This is the quiet machinery behind wealth gaps that most people never see. It's not just about income. It's about how thin or thick your financial buffer is, and how that buffer determines whether the system pushes against you or works for you. So what do you actually do with this information? First, recognize that your bank is not a passive background tool. It's an active participant shaping your financial behavior through fees, incentives, and subtle nudges. The goal isn't to distrust banks completely, but to stop assuming they're neutral. Read the fee structure. Ask questions. Many fees that feel automatic are actually negotiable, especially once your balance grows even slightly. Second, focus on building your buffer before chasing fancier financial products. A small emergency cushion, even a few $100s, can move you out of the overdraft zone and dramatically reduce the number of fees you're exposed to. This single shift changes how the entire system treats you, long before you become wealthy in any traditional sense. Third, understand that as your balance grows, your leverage grows with it. Don't be afraid to ask for fee waivers, better rates, or more attentive service once you have even a modest, stable balance. Banks compete quietly for stable customers, even at modest levels, but only if you ask. And finally, remember that the goal isn't to resent the system, but to learn its rules early enough to use them. The same structure that quietly punishes thin buffers also quietly rewards growing ones. The earlier you understand this, the earlier you can start moving from one tier to the next.